9 out of 10 portfolio managers' marketing is terrible.
Gareth, we often spend time with portfolio managers when we're supporting funds in thinking about their proposition and distribution and the like. And what strikes me is how expert and passionate portfolio managers are about what they're good at, which is the investment proposition, running money, delivering performance, and the like. But I think we find this often a challenge in translating that for investors, for the wider market. What are the kind of challenges you see most prominently there?
I mean, there are so many. And firstly, it's a real pleasure to have you with me here today, Giles. I know we've dragged you across the country and you're about to fly away to Malta for the day. But yeah, so on the side of the marketing, you're right that what often happens is a portfolio manager is going to talk very passionately about how great they are, how they've moved the money in the right directions, or how the market has maybe moved against them in certain conditions. And often the marketing structure of a fund is we'll present you with a monthly fact sheet, which will have some numbers and a paragraph of commentary. We will maybe do a presentation that we can deliver at a conference or in other sort of formalized setting. And basically beyond that, we'll possibly put a portfolio manager on a podcast or some other audio recording to talk about the performance of the fund. And what that really does, I think, is probably really limit what the art of the possible is for that fund, especially when you compare it to other types of investment products in the market and how they present themselves and how they market. But also even how you can sell through your distribution channels that you already have. And I suppose the last thing that managers often have to think about, and they maybe struggle with sometimes, is the multi-layered nature of the audience that they're presenting to.
Okay.
So maybe they're presenting initially to a distribution agent or some people tied to them that will be out selling. Then they'll move into, okay, well, we'll be talking to the advisor networks and the other distribution layers there, so maybe platforms, D2C platforms or advised intermediated platforms. And then some, but very, very few, will then think a layer deeper and talk about the actual end investors, unless they're talking about maybe some high net worth investors or some sophisticated investors that they can sell a big chunk to.
Yeah.
Beyond that, I think everybody else kind of gets forgotten.
And if we think about what's actually produced by a fund and a fund manager for a fund, you have what the legal and compliance team helps you produce, which is the legal documents like the prospectus and the key investor document. Maybe you'll produce a fund fact sheet, on a monthly basis and the like. And then you have the marketing team that will be, thinking about brand and promotional materials and the like. And one of the striking things, certainly for me, which picks up on all of the points that you've just raised, is how different financial products are to other products that we buy in terms of the brands that we think about, or even the name of the product, or what it does. If you go to a shop and buy something, typically the brand is there, you're familiar with that, you're sort of familiar with the thing you're buying. For funds, it feels very different. Like you might know the name of the portfolio manager or maybe the name of the firm, but so talk to me about that. Like how does that work? What needs to be done there? What can be done to resolve that differential?
You've absolutely nailed it, and it's so weird to me that this is the way it works. It's almost like you've got this clique of people, and all they want to rely on is the name of the individual running the money. Maybe you've got some star names out there that people kind of keep bringing up and going back to, and they'll just follow the name where they go. So fair enough, there's a bit of that, because obviously a skilled portfolio manager will deliver the right outcomes for you. But then there's a lot of portfolio managers out there that you wouldn't know if you met them in the street.
Okay.
So there's that piece. You're absolutely right that then also the backup option is to think about the brand of the management company itself. So, we've got the heavy hitters, you've got your BlackRocks, you've got your Aberdeens, you've got the names of the firms that sit at that level.
Yeah.
And they rely very much on kind of the power of that brand and brand identity. But frankly, one BlackRock fund to another, one Aberdeen fund to another, there's a vast difference in what you're actually buying there. It's Coke and Diet Coke, right? It's or Cherry Coke, right? There's so many different things at the product level that you need to try and get across in your messaging, and most don't. I mean, so a question back to you: could you name me 3 funds? Like, give me the names of them. You don't have to. You can just verbally confirm whether you could or not. But would you be able to name me 3 different fund names?
Probably a struggle, yes. But I would just be able to get. I could probably think of 1. Maybe I'll get to 3. But
do you think the average person on the street could name you 1 fund?
No, I don't. No.
Which is bonkers, right? Because you're putting, as a retail investor, your pension, your retirement fund, your ability to survive after retirement into these products.
Yep. Okay.
They're going to keep you going. They're going to feed you, and you can't tell me anything. You probably can't tell me what they are. You probably can't tell me what they do. You probably have a vague sense of the risk profile. Maybe you've got an advisor who's told you, we're at moderate risk here, or maybe at 4 out of 5. We're in a high stocks or equities portfolio versus a bond portfolio. But beyond that, you might know the manager. But beyond that, probably nothing. And that to me is totally bonkers.
Okay. I mean, what we're talking about here is not, the detail of the investment techniques that are being used in the fund. I don't think we're saying here that a retail investor should understand, that the fund's using a butterfly option versus a future versus a swap or anything of that sort. But it is sort of understanding the core components of the product. And do you think this is because there is a fear and uncertainty about what you can say, or maybe there is you're not hiding behind compliance, maybe, but there is in the back of your mind, okay, the regulator says I have to say it this way, or I can't say this, or I can't say that. To what extent is that driving some of these challenges that we see?
I think that's the easy answer. I think the easy answer is absolutely. Compliance said no, we can't say this thing. We're marketing to professionals only. That's how our permission set works. All that kind of stuff. We've put professional only on our prospectus or our other documents, and we just sort of hide behind that. We've struggled historically with compliance, saying no to things that we wanted to do and say because there was a risk there that was maybe being taken. But honestly, I think most fund managers are probably slightly scared of the retail marketing strategies and tactics.
Okay.
And I think probably they think that there's a huge budget required to do serious mass retail marketing, recognizing that each individual retail investor will probably only put a little bit of money towards you versus focusing quite narrowly on maybe an advisor network where if the advisor can do those distribution pieces for you downstream, you only need to focus your attention in 1 or 2 or 3 places. My contention with that is that's everyone's strategy.
Yep.
Everyone is doing it that way, so you're not differentiating yourself. And basically an advisor is going to go to their client with a metaphorical briefcase full of fact sheets and kids and prospectuses, and within a certain risk profile, it'll just be a almost luck of the draw which one gets pulled out and put in front of the investor, because a lot of funds are quite interchangeable in their at least risk profiling.
Yes.
And actually, I think firms that really grasp the nettle of talking about or creating a real narrative for their product, not the manager, not the portfolio manager individual, but the product itself, who can accurately describe why did this fund come into being in the first place, what were we thinking about when we did it, what niche does it fill, what sort of person are we really, really targeting here? Have we got some sustainability credentials, so we're going after people who really want to think about solar or wind or whatever. Those kinds of things, if you really grasp the nettle on that narrative, your fund will be memorable not only to that retail investor, but to the advisor who's then going to be able to talk about it more confidently. And I think the more a fund manager or portfolio manager can make their advisor networks empowered with memorable stories, interesting narratives, the more chance it is that it's your fact sheet that's getting pulled out of the bag.
Yeah.
And then I think that works also for the D2C platforms, because you can use that same narrative. You can use actual content on the fund itself, push it out to those D2C platforms, and have your fund really kind of rise to the top amongst all of those others. Because we again in the D2C platform market, you've got some quite recognizable names, you've got some quite recognizable brands, but all the marketing from those platforms is about themselves, and it's about their name. Mm-hmm. And great, I might know to go to Nutmeg or Wealth Time or whatever. Like, I know that there's a bunch of places where I can go to make some investment decisions as a retail investor. But what do I do once I've got there? Luck of the draw, right? Like, pick a one that sounds interesting. Mm-hmm. And I suppose just to throw one back at you then, Giles. So obviously we've had a load of thematic work from the regulator maybe 5 years ago, maybe slightly longer because I'm getting old, on like fund naming conventions and clarity about objectives and policies and the language and stuff. And that sort of predicated a bit of consumer duty stuff.
Yes.
But do you think that was the right focus? Do you think like the real heavy-handedness on you must call your fund this particular structure, ACD name, portfolio manager name, strategy name, is that really the right outcome? Is that the best way of thinking about it? And are there other things that managers can do around naming conventions to create a real brand for a fund?
Yeah, and in terms of where regulators are trying to get to there's lots of consumer research to say that actually the name is a core driver of how an investor thinks about a fund in the moment that they first see it. Mm-hmm. But a lot of the regulatory work that's been done on fund naming, and we have a sustainability component about that, about being clear on the sustainability investment strategy of a fund and how that relates to the name and the investment objective. A lot of that is to do with a lot of the mandatory disclosures that regulators require, like the key investor document, for instance. But that document is primarily designed to allow investors to compare funds side by side when they're thinking about subscription decisions. And we always think about funds in terms of the fund itself, but the important point you were making is that actually investors don't just invest in one fund, and they won't just invest in funds from one manager, because managers are good at certain things and other managers are better at other things. So these are always going to be part of a portfolio. Mm-hmm. So I think a lot of that regulatory work has been focused around some of those mandatory disclosure documents and being clear on those. But there's a broader point here, and I think every regulator would agree that they want information to be available to investors that is clear and understandable. And so certainly the intention is for regulation not to prevent that information from being produced and information beyond the mandatory disclosure documents. So these are really important components to what's in the fund name or how the investment is described. But that's just the entry point for an investor to begin to understand a product. Mm-hmm. And it's the broader use of the fund in the portfolio and the materials beyond the mandatory documents and beyond the fact sheets, like the promotional docs, that I think are more useful for investors to understand the product, but present greater levels of inherent compliance risk, because they're not mandatory structures, they're not mandatory formats, etc. And that's where the need to try and translate the investment proposition into plain language, but within the constraints of what the compliance team is telling you, what the legal team is telling you. That's the tension here that I think we see portfolio managers and fund managers struggling the greatest with.
Yeah, and I do feel sort of sorry for them in a way, because it is really hard to create a brand out of a really structured naming convention almost that really focuses on describe the strategy, tell us who the providers are. You can't create a separate sort of brand name for the fund. I've seen people try in the past and fail. You'll put your application in for authorization for a UCITS strategy with a catchy name, and it will just get batted back as not descriptive enough. So I understand the kind of handcuffs that kind of sit there, but that doesn't mean that everything else around that has to suffer that same kind of fate. And I think probably compliance teams do need to start releasing that handbrake a little bit and allowing content teams, marketing teams, distribution teams to be able to be more creative with what they're doing. And frankly, we've run the roadmap to 10 billion strategic work a few times now with clients, and it is interesting that you can explain fairly basic strategies for marketing, clipping a portfolio manager's longer podcast episode into smaller bite-sized chunks for reuse across other social platforms, and that will seem quite out there in the sort of world of funds, but that's very basic social strategy. And I think fund managers fail to recognize that, yes, in particularly advised and intermediated markets, a lot will be driven by what the advisor does.
Yes.
There's also a bottom-up push that comes from the investors as well. Like if an investor goes to an advisor and says, I've seen this fund in the market, what's that about? Is it worth us looking at as part of my portfolio? That's got real value. Like then the advisor is thinking, oh, people are actually interested in this. Maybe I should be telling other clients about this fund and, thinking about things that way. So I think there's a real gap for retail-focused, product-level marketing in the investment fund space, and I'm sort of astounded it doesn't really exist. I know some people are sort of playing with it a little bit, but beyond that, there's you don't go on TikTok or Instagram and see a reel for a fund, right? Why not? Frankly, why not? So that's one thing, and what we tell our clients and what we try to explain is there's a lot you can do in that space to generate that interest. Advisors are also people too that they spend their times on social platforms and other places, and they see what's trending and what's doing well content wise. So you can influence them and their buy-in and their distribution decisions in as much the same way as you can for your kind of retail target audience, if indeed that's your strategy. But don't hide behind, oh, well, we're only going to distribute to professionals only. We want to have a very clean marketing gap, because frankly, we know that, and we know that your marketing literature is going from the advisor to the client. Yes, it was advertised to the advisor, and you've sort of hid behind that professional only gap. But it is going to the end retail, so you might as well grasp that and do something real with it.
Yeah, and I think it's important to, in the translation, to think about the audience. So what's going to be understandable to the audience, or what's their inherent knowledge, and how you're going to describe that to a mass market retail investor is clearly very different to a professional investor. I think some of the other challenges that I see, particularly coming from a compliance perspective, is, well, we have to include these risk warnings, or it has to talk about this, and often I find the communication of funds actually overweighted on risk. Of course, it's very important to communicate the risks of the fund, but I think more important to communicate the outcome that the fund's going to deliver as well. And the idea that actually I've got so many risk warnings that the FCA tells me to include, or ESMA tells me to include, or whoever my kind of regulator is, reduces the actual space for, well, what can this fund deliver for me? And then if I'm interested in that, then what are the risks? How does it fit into my portfolio? And that's where I think an advisor can support that. But also, there should be that balance in what's the outcome, what's the risk for a retail investor if they're interested and engaged in that, to actually understand that themselves as well. So that's where I think some of this tension and the translation is more difficult of the outcomes. And often, some fund managers might actually just give up and say, okay, we're just going to describe all the risks, that's compliant, which is actually not the outcome that any regulator is wanting. They're wanting a bit more balance there in terms of retail investor understanding.
Yeah, and for sure. I think, one, people probably just aren't being creative enough in the solutions to that problem. And two, they're not recognising the point that you've literally just made, which is that the regulator doesn't want you to spend 15 pages describing your risks. We look at the CCI documentation.
This is the Consumer Composite Investments regime that's coming in the UK. Yep.
Yeah, exactly. And so, hey, you will produce this digital-first consumer disclosure document, and in it you will talk about all the key points, and they've been very clear on kind of what you have to focus on and what you have to bring to the fore and what's most important. And as part of that, they've said, look, you can put you're going to be putting your risk things in there, but have you thought about ways in which you can deliver that risk message in a clever way, right? Have you thought about using icons to quickly visually show that certain risks apply to a fund, for instance, which you can then drill into and give more detail on the actual risk itself if people want to understand that, if they don't already. What are the other ways that you can think about delivering risk messaging that gets the information across to the consumer quickly, concisely, in an easy to understand way, but also doesn't take up the entire document, so that you can focus on the bits that are important, which is, what does this fund do? And how does it do it? And why does it exist? And why is it right for you? And, we've got the bit around advice and rolling back on some of the what counts as regulated advice and the guidance gap that sits there. So, people can start to talk about the type of investor's situation that this fund would be good for. Hey, you care about the earth, you're interested in social outcomes, you're interested in environmental outcomes, great, then this fund, this solar fund or whatever is exactly the right thing for you. That we saw your need, it wasn't addressed, it's got this risk level, whatever, and we can deliver a message around that that attracts you as a person who otherwise is staring at a list of dispassionate fund names across a platform.
Yeah, and I think we've even seen regulators start to be more creative here, and I think they're looking for the industry to be more creative. So rather than, as you're describing, having just a paragraph of text, are there visual labels that we can use there? Can we use traffic lights or labels and like? And then the opportunity of digital communication and effectively layering information. So we're all quite familiar with sort of tooltips, the little icon often that we see on websites or apps where you can hover over and see what does this label mean or whatever it may be. And the ability to drill into information if you're interested, then come back up to the summary information. That's something you can't do on 2 sides of A4 paper. You then need another 2 sides of A4 paper too. So there is I think a desire from regulators not only to use digital means of communications and all of the opportunities that presents, but also can you, I think, make this more engaging for an investor, so the investor doesn't think, I'm going to have to read 3 paragraphs of text here to understand, is this fund sustainable, or is it green on this or red on this? Can I just do that with a traffic light? And that communicates, assuming I know what the traffic light represents, this is green, and then alongside another fund which is red and one is amber, or whatever it may be. So regulators are kicking off that, and I think they're looking for industry to seize the opportunity. One of the reasons why the FCA has introduced the Consumer Composite Investments regime in the UK is precisely to try and make some of these, documents that are produced more accessible, more meaningful for investors.
And they're regulatory documents, right? But they are described by the regulator as marketing materials. And that's their point, right? You have to get them authorised if you're an OFR firm coming in. You need to be able to distribute them. So, they're marketing materials first and foremost. They're not risk disclosure documents. Yes, they have an element of that to them, but that's not the primary function. And I think probably the last point I would make on this is look at all the other investment types out there and how they're being marketed. You and I both come from a crypto world. We've dealt with many crypto firms over the last 3 years, all marketing into the UK under the Section 21 regime. The type of content that those firms produce for, frankly, let's face it, a higher risk asset than a fund is bonkers, right? It's great. They've really understood the way that people engage with marketing content. They've really understood with how to send a message across, and in the same time describe the risks associated with the product. And we often see when we approve financial promotions in that space, the need to check that there's a balance in the positive and negative, but there's a way of doing that such that the content is probably about equal, so that the positive stuff is there and prominent, and the negative stuff, or the risk-based wording, is also there and present, not hidden, not deprioritized, but doesn't take over the whole page. Because frankly, if a fund manager ran a crypto project,
Yeah.
risk disclosures would be 99% of the document, right?
They would indeed, yeah. And I think there's a couple of reasons why I think crypto firms have been able to adapt and translate better. Firstly is they're digitally native. So they're companies that have been created in a digital era rather than, let's say, the asset management or fund industry that has come into the digital era. So it's the ability to use social media effectively. It's not just about having a website anymore. It's about using social media, having an app. It's about having the risk disclosures available and accessible and clearly accessible.
Yep.
But as you say, not taking up 9/10 of the screen space, with actually the 10% for the most important thing, which is what the product actually does. Because there's no point in having 90% of risk disclosures if you don't understand what the risk disclosures relate to in the first place. And I think the other reason why they've adapted and been successful is trying to reduce the amount of content to be more concise, because there's only a limited amount of space on an app screen or a web page, rather than printing off a fact sheet of 4 pages or 6 pages where actually you don't need to be as concise. So, and as we know, it takes longer to write less. And so that's I think that's a couple of the reasons why I've seen them be more able to communicate on a higher risk product in actually a very effective way.
1,000%. That's exactly it. And nobody reads a prospectus of a fund. I bet very few people even read.
Well,
the
I do
two-page
sometimes.
kit.
Gareth,
I know
but,
you.
Sorry, yeah.
I know how you spend your Fridays, but that's it. People are not digesting that amount of content, particularly when they're maybe invested in 6, 7, 8, 9, 10 fund products that they can't even tell you the name of, let alone like all the risk disclosures for each one, etc. So. If your strategy is about distributing very text-heavy, risk-heavy documentation with maybe a fund manager giving you a heavily scripted video once a month about their performance in the market, then probably what you need to think is that really enough? And in today's world, I would say absolutely not, because even advisors are being overwhelmed by the amount of information that's being thrown at them. And also, and I'll sort of make this as my last point, most fund managers, I would say, rely too heavily on performance as their way to market. And I think that gets you so far, but I'd call that a fundamental. And I don't think you will be thinking enough about, if you're relying entirely on performance, or you're relying heavily on performance as the way of measuring or marketing the fund, you aren't thinking about the attention level. You aren't thinking about raising awareness at the top of that funnel to get someone interested enough to check your performance in the first place. And if you don't have the top of the funnel, then you're not going to get enough into the second level of the funnel to convert into an investment in due course. So my message ultimately is, don't forget the top of the funnel.
Yep.
Make more content, distribute it, be more alive to your market and to your audience. And hopefully your performance is there and you can convert it.
And so I think what we're saying is, it's important that information is available. We're not saying you shouldn't make information on risks available or so. That's important that that's available. What we're saying is how to make that information available, how to make that digestible, how to translate, and almost give the investor what they need at the start, but the ability then, if they want to dig into more information on specific risks or specific parts of the strategy, etc., and how to communicate that effectively. And I think what you said several times, Gareth, is trying to make this more bite-size. So it's not a half-an-hour YouTube video. It's the ability to be comfortable that it can be a 2-minute YouTube video with all of the necessary disclosures and access to it, but there are 15 of those 2-minute videos, and maybe I want to watch all 30 minutes of it, but equally maybe I just want to watch 4 minutes of it.
Yep.
How can that be done effectively without sort of legal and compliance saying no, that doesn't work, on the portfolio manager speaking in terms that maybe isn't understandable. So it's the way in which all of that is communicated effectively.
Every investment is a journey made by a customer, and that journey doesn't have to happen all at one point in time. And you can interact and engage with that investor at multiple touch points before they get to the point where they read your kid or put their hand in their pocket type their credit card into a platform. So think about the multiple stages that someone might become aware of you, aware of your product, check its performance, trust it enough to buy into it, and then do the conversion. So that's it. Do more, be more engaging. If you've relied entirely on disclosures, you've not done enough.
Great. It's been great to talk to you about this.
You too, Giles.
Thank you very much.
Catch you soon.